Every single second, thousands of people in India are sending money to each other instantly. There are no account numbers to type out, no waiting for business days, no proprietary card networks, and no holding funds in some random digital wallet balance. You literally just enter a phone number or a simple alias, and boom, the money arrives in the receiver's bank account in about 2 seconds. Meanwhile, in the US, traditional bank transfers can still take days to clear, totally bogged down by legacy systems that were designed decades ago. So, how exactly did India build one of the fastest, most scalable payment systems on planet Earth? And why are massive companies like PayPal, Venmo, and even national governments scrambling to catch up to it? Today, we are breaking down the complete architecture of UPI, the Unified Payments Interface. We're going to explore the APIs, the NPCI switch, VPA routing, real-time settlement, and the engineering decisions that fundamentally change digital payments forever.
To really appreciate this, we have to talk about the jaw-dropping speed difference we're dealing with here. Look, in a lot of Western systems, sending money from one bank to another requires batch processing. Your request goes to a clearinghouse, sits in a queue, and maybe it settles in 1 to 3 days if you're lucky. With UPI, that entire life cycle is compressed into 2 seconds. And as you'll see throughout this explainer, this isn't magic. It is a fundamental, ground-up shift in payment architecture. And this new architecture isn't just fast. It is operating at an absolutely unprecedented scale. We are talking about 10 billion monthly transactions. That is 300 million operations happening every single day. Every single day. Just to put that into perspective, the UPI network actually handles more transaction volume than the US, the EU, and China combined in this specific real-time payment space. It maintains a 99.95% uptime while processing a level of massive, concurrent traffic that leaves traditional networks totally in the dust.
Part 1. The Real-Time Payment Revolution.
Okay, let's dive into this. How did a country with over 1 billion people completely bypass the friction of legacy systems to create this instant reality? Well, there are basically 3 pillars to the UPI paradigm shift. First, it's 24/7, 365. UPI completely eliminated the whole concept of business hours and weekend processing delays that plague traditional batch banking. Second, zero user cost. The system bypasses the heavy fee extraction of traditional cross-border and private networks, making it completely free for end users. And third, instant bank-to-bank movement. Money moves directly between bank ledgers in seconds, bypassing the need for digital wallet intermediaries altogether.
Part 2. The architecture of instant. So to understand how it achieves that speed without a middleman holding your money, we really need to look under the hood at the technical engineering. Let's separate this ecosystem into 3 distinct layers. On the user side, you have the UX layer, payment service providers, or PSPs like Google Pay or PhonePe. These apps initiate the API requests, but they hold absolutely zero user funds. In the middle is the routing layer. This is the central API backbone run by the National Payments Corporation of India, or the NPCI. This switch authenticates users, resolves addresses, and basically orchestrates the whole thing. And finally, the ledger layer, the actual issuer and beneficiary banks where the capital actually lives.
Let's break down exactly what happens when you press Pay. In Phase 1, the user app initiates a payment. The PSP authenticates you via a secure PIN. But again, the app itself doesn't actually process the money. Instead, it fires off an API call to the central NPCI network. Think of the NPCI switch as the brain of the operation. It catches the request and handles all the routing logic and address resolution to find exactly which destination bank ledger the money needs to go to. And that naturally builds right into Phase 2, the actual real-time settlement. Once the NPCI knows where the money is going, it doesn't move those funds into some temporary holding account. Instead, it orchestrates a debit request to the sender's bank and a credit request to the receiver's bank, simultaneously. The banks act as the ultimate back-end ledgers. Because the NPCI is directly communicating with the bank's APIs in real time, the settlement happens instantaneously, entirely avoiding the need for any intermediate holding accounts. So, to summarize this incredibly elegant architectural dance, first, the payment app initiates the API call. Second, the central NPCI network resolves the addresses. Third, the sender's bank successfully debits the funds. And fourth, the beneficiary bank credits the funds. This highly complex, concurrent, atomic validation happens across multiple separate institutions, literally in the blink of an eye.
Part 3. The VP breakthrough.
Now, all this amazing back-end engineering is useless if normal people can't figure out how to actually use it, right? India did what legacy banks said was impossible. They made account numbers obsolete.
Before UPI, sending money to someone's bank was a total nightmare. You had to ask for their 16-digit account number, their bank name, their branch location, and an 11-character alphanumeric IFSC code. UPI solved this by abstracting those sensitive, clunky legacy banking details into lightweight cryptographic pointers. The system forces the central registry to handle the routing logic, meaning users never have to touch a raw account number again.
Instead, you get a super simple alias, a virtual payment address, or VPA. It looks just like an email address, for example, your name at ICICI, and this brilliantly illustrates the genius of the system. Because of the single abstraction layer, your VPA works across any bank and any app. It can be easily embedded into QR codes that you can just scan at any street vendor or checkout counter without any special cash register integration needed. Think about that. Over 400 million Indians never had to learn their bank account numbers because they simply don't need them anymore.
Part 4. The Zero Ledger Paradigm.
Okay, so we've got the incredible speed and we have the seamless usability. But now let's shift focus to the massive financial disruptor here, why this system is completely free. Globally, there are two really divergent paths in payment architectures. First, you have the stored value paradigm used by most digital wallets. Here, the wallet acts as a proprietary middle layer. You load money from your bank into the wallet, it sits there causing friction, and then it eventually moves to the receiver. But below that is the protocol paradigm, the UPI model. UPI builds an instant API bridge straight from the user's bank to the receiver's bank. There's no intermediary ledger. There is literally no middleman holding your money.
This is what system architects call the zero ledger rule. By completely eliminating stored value wallets, UPI effectively removed the toll booth from digital payments. Digital wallets have to extract fees to support their business models and intermediate ledgers. But UPI? It's a non-profit, federated digital public infrastructure. It acts purely as a protocol. And that's exactly why Americans pay roughly $100 billion a year in processing fees, while everyday transactions on UPI cost users absolutely nothing.
Part 5. Beating the global giants. This brings us to a direct head-to-head comparison. Let's look at exactly why Silicon Valley's legacy models are fundamentally disadvantaged against this native protocol. When we line these systems up, the differences are super stark. UPI offers a direct API, interbank protocol, real-time settlement, zero intermediary holdings, and zero user cost. Now compare that to PayPal, which relies on a digital wallet architecture resulting in delayed, batched bank settlement, trapped wallet balances, and high variable fees. Alipay offers instant internal settlement but completely locks your funds inside its specific wallet ecosystem. Venmo offers social payments but severely delays actual bank settlement. And Zelle, while offering zero-cost direct transfers, is architecturally bound by legacy bank consortium systems.
When we look a bit closer at these wallet-based giants, the structural friction becomes pretty obvious. PayPal is basically trying to be everything at once: a wallet, a gateway, and a processor. This heavy structure actually demands that funds sit in an intermediate balance layer, allowing them to extract heavy transaction and international fees. Over on the flip side, Alipay dominates the Chinese QR ecosystem, but it is fundamentally a walled garden. It relies entirely on a closed-loop wallet structure, meaning users have to store funds within their specific corporate app before transacting. UPI wins here because it's an open protocol. Competition among dozens of different apps drives innovation instead of forcing user lock-in.
And U.S. domestic systems fare similarly because, well, they were built for banks, not people. Venmo definitely popularized the social payment layer, but architecturally it functions a lot like PayPal, trapping money in a digital balance rather than settling immediately. And let's be real, speed matters way more than social features. Now, Zelle does offer direct bank transfers without a wallet balance, which is a big step forward, but it is still hopelessly constrained by its reliance on the legacy 1960s-era ACH network backbone. It's essentially putting a fresh coat of paint on incredibly outdated pipes. Even new U.S. systems like FedNow are functionally just copying the UPI model, just 6 years late. As the saying goes, India didn't innovate on credit cards, they made them completely obsolete.
Part 6. An exportable global standard.
So the crucial point is, this is exactly why the world is paying so much attention right now. UPI isn't just staying in India. It was designed from day one as an exportable standard. By linking UPI with international real-time payment systems, they are bypassing the archaic, super expensive system of correspondent banking entirely. Nodes in the EU, the UAE, and Singapore are already adopting and integrating with this federated API-first network. It is proving that digital public goods can seamlessly cross borders without a single corporate entity holding a monopoly. The country that effectively fixed payments is now exporting the solution. Ultimately, you have to remember, UPI is an underlying infrastructure protocol. It's not an app, it's not a gateway, and it's not a private processor trying to extract a percentage of every sale. It's an open protocol. It proved that a system treated as a digital public good can vastly outperform the fragmented, privately owned walled gardens that currently dominate global finance.
UPI has proven something the financial world genuinely didn't expect. A payment system can be instantaneous, massively scalable, and completely free for everyday use. It has made legacy credit card networks and multi-day batch processing look like relics of the past. And now, countries around the world are trying to build the exact same thing. The future of payments may not come from Silicon Valley. It may already be running at full speed in India. Are we ready to catch up? If you want more explainers breaking down the architecture of global financial infrastructure from Stripe to FedNow to Swift, make sure you're subscribed. Thanks for watching and keep questioning the systems you use every day.